Hello, everyone. A warm welcome to this session on impact investment. My name is Jean-Sébastien Lasson. I'm a partner at PricewaterhouseCoopers, and I lead our Swiss asset and wealth management practice. I'm delighted to have you here today with our panelists talking about impact investment. Impact investment has been there for many, many years, as we all know. But the feeling today is that with these challenges, the global warming, climate transition, we hear more and more about impact investing, especially in developed countries. And that's what we see as well from our practice at PricewaterhouseCoopers, a huge increase in investment, especially from the wealthy individual and even retail investors now, and we're going to talk about that in a minute. But in the mind of many investors, impact-driven investment remain the playing field of developing countries. So what differentiates impact investment? I don't think, they will learn anything now, but there's two things really that are crucial for impact investing. Generating a positive social and environmental impact on the planet, right? And this is the impact risk, while also, providing a positive financial result. The financial risk, and this is the differentiator with traditional investment. If you want to make impact investment, you need to have impact targets, and this is the core of these asset managers that we will talk about in a minute. How do you prioritize these targets? In today's global warming, where are the biggest gaps? Where are the biggest needs? And I think this is one of the key things that an asset manager needs to do first, is set the targets. What are these targets? And then you need to measure them, right? And the measurement is one of the biggest challenges, and we all know that. And that will also be a question that I will ask the panelists today is, what's the best measure so that we can compare you among your peers and compare your investments? And how do you measure the impact of these investments? Who's providing that impact? Is it the company itself? Is it the investors? Is it the fund? How do you allocate the impact to these parties? So on that note, I will introduce our panelists. I'll start with Michael. Michael is Head of Private Equity and Responsibility Investment at AG. He has 20 years of experience in advising, running, and investing in retail banking, microfinance, and SME lending operation in over 25 countries. Benjamin, Executive Directors, Impact Finance Management. You are an impact investor and entrepreneur. You co-chair the Management Committee of Impact Finance Management, which has disbursed since October 2011, 233 million in agricultural value chains in Latin America. Xenia, Policy Advisor, Swiss State Secretariat for International Finance. You're a Policy Advisor in Sustainable Finance at the Swiss State Secretariat of International Finance. Pierre, Head of Thematics, Private Equity at Pictet Alternative Advisor. You joined Pictet in 2007. You are one of the 5 members of the investment committee, and you lead the thematic private equity investment team. And finally, Nicolas, Head of Fund and Co-Investment, Blue Earth Capital. You joined Blue Earth Capital in 2022 and have 14 years of industry experience in impact investing. So, first question, and I can start with you, Michael and Benjamin. When you look at the best practice about how investors and managers set target, and when you look at the past 20 years, do you see a difference in the gaps and the challenges that you face as impact managers and impact investors? Do you see the thematics that have changed now that we're looking at global warming, climate transition? Are these the same targets and thematic you've had 10 years ago, or you see things moving around?
Yeah, I hope this works. Okay. Good morning, first of all. Thank you for having me. Looking forward to the discussion. So do I see a change in the thematics? Well, maybe as a background, so at Responsibility, we're around for 20 years, and we're doing impact investing ever since. When we started, it wasn't called that way. We had all kinds of names for it, but eventually it got the name of impact investing. Is the challenge different? Are the themes different? Not really, I would say. If you compare it to 10 years ago, it's roughly 10 years ago that we decided to focus, in addition to our traditional topic that we started with, financial inclusion, and a second topic that we were focused on, which was agriculture, sustainable food, we added climate as a topic. So yes, in that sense, the climate topic has really taken over the sector by storm, I would say, over the last 10 years. The challenge is no different. The challenge is no different to be very clear if you're looking for an impact investment in terms of what impact are you looking for. And our approach to this basically is we don't start with screening a universe and then selecting what is impactful, but we start with themes. And it's these three themes that center ourselves. This is around financial inclusion, economic inclusion, if you like. It is about a sustainable agricultural value chain and sustainable food, and it is around climate. Now, has it changed how we're approaching and how we're systematizing the impact? Yes, that has changed. So I would say that this has really developed over the last couple of years. There's much more clarity. The framework which we're using is the Sustainable Development Goals. We use those as a reference point, and each and every investment that we do and each theme that we cover relates to those. And then we get into the measurement. I think we'll discuss that.
But from the investors, when they talk to you and they invest, do you see a different pattern in the investors that are coming to see you? And do they require a different style of impact investing than 5-10 years ago? Or are they sensitive to the same topic today than before?
I think there's a lot more clarity as to what does that mean, impact investing. So we're starting to see in the discussions over the last 5 years in particular that investors, institutional investors, not kind of the specialty investors that have been looking at this already for 20 years, but those that are new to this, they come and they have a very elaborate conversation with us around questions like, what is your theory of change? How do you approach this? How do you measure impact? So we're moving beyond the storytelling, which was still, and it will continue to be key, but we're moving from only storytelling to actually discussing a specific theory of change and data behind it as well. So the metrics are also being discussed now. Is something that 5 or 10 years ago was a lot less systematic.
Benjamin, what's your perspective from impact finance? You're a big investor in Latin America. Do you see the problematic being the same that they were 5, 10, 7 years ago, or you see climate transition, global warming being a more prominent topic in the mind of investors?
Yeah, thank you, Michael, sorry, Michael is there.
Jean-Sébastien.
Jean-Sébastien, for having me here. I joined Michael here saying that we've been doing that for 12 years. We have impact in our name already, so the interesting thing is there's always debates on when I tell even a professional on a new product, and he tells me, no, this is not impact. What is impact? What is not impact? I think at the end, we've been through this definition battle. Sometimes it's a word battle, right? But in the thematics and in the issues where we operate, I think it has really been, how to say, aggravated with the pandemic. And here, in general, the investors in Europe, they care about climate change or environment or the plastic, right? But if you ask investors in Latin America, they care about social justice, about food security, and that's really what they live. And with the pandemic, the number of jobs that were lost, the number of people going into informality was terrific, was dramatic. And I think the needs here, what we evolved in our discourse is that we need to have both social well-being and planetary health, and this is what we call regenerative. And at the end of the day, the investors, they are sensitive to that when you explain them. It's still, after 12 years, it's still a work of explaining to investors what we do and why it counts.
But yesterday we were in the bigger room and there was a lot of talk about the performance return that is expected by investors,
Yes.
right? Have you seen that coming down? Because we say, well, global warming is happening, it's impacting all of us. So maybe I need to adjust down my expectation of performance return of impact investing, or we still have the same expectation that we had a few years ago?
Well, I think institutional or any investor has their different needs and different performance targets. It's not if it's impact or not, and then they can decide to be in an asset class. Like we are often put into emerging debt, so we're there, and we are a market where they want to be, right? And they want to be in their asset allocation. I think then the talk is not only about performance; it's about volatility, about liquidity. Well, here today we are talking about private equity, and it's a challenge for us that doing private debt, we are liquid. That's our advantage. Then returns, you said returns, of course we are less attractive in terms of the returns that we present and that we've been achieving. But at the end, this question of performance is always specific to an investor and their mandate. And it's our work to understand what they need and what performance they're looking for, volatility, liquidity, and then see if they want our product. But at the end, you said it, we start with saying, why are you talking with me? Do you want to address this SDGs? Do you want to contribute to this SDGs? You want to contribute to climate action? Yes. So that's why you're here. Unless, if not, if you are just here for a financial product and for your return, then it's not me, the right person you have to talk to. Yeah.
Okay, thank you. Xenia, I'll come back to you in a minute. Pierre and Nicolas, your two firms are investing more in developed countries, or at least they're investing also in developed countries. We've seen impact investing growing significantly in Europe over the last few years. What's your perspective when you have this debate, developed countries, developing countries, and why there's so much capital these days for investing in wine farming and similar things in Europe, and not as much has been done maybe in developing countries? What are your views on that?
Thank you so much, Jean-Sébastien. So I'm Nicolas Müller from Brewers Capital, and indeed we invest in both developed and emerging markets for both social and environmental impact. I think one of the things we see is a strong divide between developed and emerging markets at all levels in the types of investors investing in those products and the frameworks used. But at the end, it's one global planet, and so we have to be careful about how we integrate all of those variables. One statistic that is, I think, quite incredible is if you looked at the least developed countries in the world, they generate 1% of the emissions, but they suffered 90% of the climate-related deaths to date. And so you realize to solve these issues and to solve the impact in emerging markets and in developed markets, you really have to have a global approach. And I think one thing we need to take into account as well is you can't have social impact versus environmental impact. Both need to be taken into account. There needs to be a just transition. And we think those thematics are taking really place today. I think one point you mentioned is a lot of capital going to developed markets versus emerging markets. I think it's clear there is a perception of risk in emerging markets, especially after recent events, the war in Ukraine and other events have led to a flight of capital from emerging markets to developed markets. One of the points we focus a lot actually in our portfolio is risk and risk management. And if we look at our portfolio in the last 2 years, it has been extremely resilient in emerging markets. And that's because we focus on essential goods, essential needs, financial inclusion, basic healthcare services in remote communities. It's not because interest rates are rising in the US that people will stop going to see the doctor. They're going to stop needing financial services. And so we think one thing we need to focus more in a dialogue with investors is risk and how impact investing can actually be a defensive allocation.
Pierre, your view from Pictet Alternative Advisors, you are investing in Europe, you have Luxembourg products. What is the big differentiator between you and the other firm here that are investing more in developing countries? How do you see the investor's perception?
Sure, and good morning, and thanks for having me. I would say our private equity programs focus more on developed economies in our investments, which doesn't mean that they cannot have potential impact. I think the notion of impact, in my view, is not necessarily correlated to investing in emerging markets. There are several strategies or themes that can have positive contribution to different areas. I think we have developed our thematic approach around 3 different themes, of which 2 can have sustainability and impact investments as an objective. One is an environment theme, which considers the environment quite broadly, and that assumes that it's not only about climate, it's always also about a number of other factors that have to be taken into consideration. And the other larger theme is health, where there as well there can be different notions of impact. And I think it comes down at some point to the measurability of the investments that we do, so down to the collection of data. What cannot be measured cannot be impactful. So this is, I think, at least on the paper. But on the other hand, having this measurement of impact precludes some companies to receive capital. And in that sense, we have a broad spectrum. We're not sticking very precisely to the KPIs that need to be collected. We have some qualitative framework that we have developed and that we try to quantify in order to have this broad view and this broad spectrum when it comes to responsible investing.
And maybe, Nicolas, just one more question. You are investing indeed in developing countries. So when you're meeting investors, you know, what do you feel from their perception into their expectation in terms of performance? And why today we're seeing a lot more investors coming in to invest, as I said, in Europe, in developed countries? And why has this been so slow in the investment in developing countries? What do you hear from investors today? Would they want to put their money more into developing countries? Are they interested in products that invest in both at the same time? What's the sentiment from the investors?
No, thank you so much for this question. So historically, Blue has started really investing in developing countries, even in frontier markets. And here we see a strong appetite for high net worth individuals, family offices, foundations that still have this big mission to invest in the most difficult geographies. On the institutional side, where we see typically these institutions have not had a strong allocation to emerging markets outside of impact, just private equity in general. They have not invested in emerging markets, or if they've done so, they had mixed results. So it's difficult to convince them to go there, and they plan to allocate more with their impact portfolios into developed markets. But the mission is clear. We need, in emerging markets and developed markets, we need returns to compare favorably to our traditional private equity investments if we want to allocate a significant amount of capital. And for that, we need to deploy smartly in the right subsectors and generate strong returns as well as strong impact returns.
Okay. I forgot to mention, if you have any question, please do not hesitate to interrupt us. You can just push on your button and ask question throughout the discussion. Yes, go ahead.
So we hear this a lot between emerging and developed and impact investing, and you're a great point. If you want to come here and do impact investing, sit down. If you don't, go somewhere else. Does anybody have a number of, say, the 3-year returns for impact investing versus people who want real returns? What is the number that you can give us, right, that says, I'm willing to put money into this type of project that I know is going to help the environment. give me a number of what I can return, what return I can get versus regular investments.
Well, with the disclaimer that past returns are not necessarily what you will get. What we are working on, you have to compare the same, apples and apples, right? So here we have our colleagues that generously share their performance, but it's difficult for us as an impact emerging debt fund in food and agri. The only benchmark is our colleagues there from responsibility. So we've been doing all right the last 3 years, 3.5% in dollar. Now we are, with higher interest rates, we can write loans with the higher rates, and we are increasing this yield. But then it's just what risk is behind. You mentioned, Nicolas, the investor has to understand what is the underlying and how the risk management is done and what processes are in place. I think because it's challenging to invest in those emerging countries. So it's difficult to tell you I can tell you what an investor would have in your fund. It was not as good, but now they are going better. So it's difficult.
Yeah, so I think I should say something. Yeah? So I think it's hard to say kind of across asset classes and different themes what would be the return. But in the end, on a private debt portfolio investment or a fund investment, you should be able to get 3 to 5% in dollars, somewhere around that. The question then is, what is the volatility of this? And I think that's where part of the story really lies. You would expect in a perception, we're talking emerging markets, volatility must be very high. The reality is volatility is actually pretty low. And that's where kind of diversification play actually comes into it. Even in an environment where US Treasuries are actually an attractive investment opportunity compared to these sorts of returns. Now on private equity, I think we're talking emerging markets private equity. So I think going out to any investor, impact or not, and promising anything below a 20% return in dollars basically ends the conversation right there. So that's just the reality. So yes, you will find in these conversations, you need to first of all understand, is an investor ready to talk impact? Does an investor understand or is he willing to understand that actually impact can be an opportunity? It's not a risk, it's actually an opportunity. And can it be explained reasonably that in the end the returns behind the private equity investments that you do, which are mostly then in local currency, must be even significantly higher for you to deliver this in US dollars. Because again, the FX risk is very significant. So again, that's the sort of conversations you need to have, which basically in summary means, yes, you need, when you have the conversation with an investor, there needs to be an openness and willingness to talk about impact. But in the end, there's not so many that are ready to forego return for this. And that's the reality. If we want to get scale into the sector, risk return needs to look right, even without the impact.
If I may just add to that, and I'm not sure the question is whether the returns on impact are different or the returns over investment in developing countries. But looking at impact, I think my personal view and the stance we've taken is that there is no compromise done on the underwriting. There's no compromise done when it comes to impact. So there's actually, my personal conviction is that you can assume and expect to have higher returns even from green or impact investments, depending how you define what segment you will focus on, because there will be this green premium, because some companies that will embark on a sustainable journey will be more valuable over time, and this is our conviction. So I think even the discourse of saying there is compromise to be made on returns, to me is of the past, and the future is really there is superior returns to be made in that area. And again, on private equity, I think it's very difficult to speak of returns as an asset class. Generally speaking, we should assume that PE should generate above market returns, but not necessarily assume the return as an asset class return, as the heterogeneity in the different portfolios is extremely large. So the selection of partners makes a very big difference in the bottom-up selection of companies as well. So it's difficult to speak of it as just an asset class.
Gisenia, you want to say something?
Yeah, I just wanted to say something on the return side is, and I don't feel comfortable disclosing our returns to date, but we've been, the basis of Blue Earth is to generate market rate returns alongside impact, and I think historically we've been very successful at that, as generating, high double-digit returns. One thing that is clear to me is, if you're offering a product or services that have a better, for example, environmental impact, and you're my customer, and I say, hey, you're paying $10 now for this product, which is generating hundreds % of emissions, and I provide the same product at a lower cost with lower emissions, I think you're going to switch to my product. And so I think I have a very untapped potential, and we see a lot of companies now that are benefiting from these transitions, either environmentally or socially. And if you look at the business case, it's very strong. So we feel we're quite excited about the business case from a financial returns perspective of those investments.
Xenia, maybe I turn to you now. We at PwC, what we see now of this asset class, private equity, is that regulators across Europe are trying to open up a little bit and broader the type of investors, right? And I know a lot of these asset managers now are targeting wealthy individual, and even retail investors are starting to see them. When you look at this industry, the challenges that we have, there's a gap of several trillion every year to finance a global transition. And as a regulator, do you try to make this product more possible for any type of investors? Are you trying to enlarge the type of investors that can come into it? Is this something that is good? How do you see this market evolving and broadening the circle of investors having access to impact investment?
Oh, thank you. Thank you so much. First of all, good morning, and thanks for having me. So at the Ministry of Finance, we're currently in the middle of addressing these issues. So last December, we issued our Sustainable Finance Strategy report, and mainstreaming impact investment products, making them available to a broader range of investors is one of our areas of action. So what we've been doing so far is, we have been in contact with leading financial institutions offering impact investing products, and we're really trying to figure out what is the problem, why are these products not available to more investors, and most importantly, from my perspective, is the question, what is the role of the state? What is a regulatory issue? So this was really the first question we tried to assess is there something in our financial markets legislation that creates a big hurdle to a broader use of impact investing? And I mean, I don't have the final answer today, but what I've seen so far from the industry and from talking to stakeholders is that the primary problem is not the regulatory framework, the Swiss regulatory framework at least. So it's my question is really what should we do as regulators? Should we probably taking more an encouraging role, an awareness building role? Should we? So these are more these are the questions we're having right now, and I'm really happy to be here and to get this information from. I
mean, now we have the SFDR, right? We have this classification of funds. I mean, in retrospective, has this helped the investors to better understand the products and the impact delivered by these funds? Is it clear today that an Article 9 fund has a positive impact on the planet? As a regulator, a year or 18 months after SFDR, is this positive?
So as a representative of the Swiss government, I'm not here to comment on EU legislation. As you know, we have a kind of a different approach in Switzerland with much leaner regulation. And I mean, it's not that we don't have anything. We have, for example, we issued last year the position on greenwashing prevention, and there the notion of impact is very. The Federal Council states clearly that we need to have this notion of intentionality. Now, how we're going to implement this is in the making. A lot of people involved in this room are very well aware of it, and we're going to see how we can best implement this position. But the position is clear now. How we can implement this? Is it through self-regulation? Is it through state regulation? It remains to be seen. But yeah, we have our sustainable finance principles, policy principles, and they've proven their worth so far. So yeah.
Adrian, I come back to you. There's just one question there before.
I think, Andrea Webster, World Benchmarking Alliance, I think the question that you raised about if there are regulatory hurdles is really pertinent, because if we're going to get to scale to impact investing, what other hurdles exist to open up the flow of money, especially in the wholesale market? And perhaps this is questions for others, is that the UCITS structure and Article 9, and we know that a lot of fund selectors, that's the default, but the type of deals that you're looking at in private equity, can those be aligned? Is there a mismatch there, or do you feel that the existing structures allow you to take impact to scale in the mass market?
I would say the major hurdle with the UCITS is certainly the liquidity gap that you would have for a product, and so I would see a mismatch there. But I think more importantly than regulation and framework is the market itself, right? It's what really can drive the appetite of investors, be there wholesale, retail, or institutional investors. So I think on the thematic of impact and sustainable finance, there is a world that has changed, and this is what should drive the regulation, and the regulation should not drive and favor the impact. I think that this has to come from the market. When you see talking about SFDR, and sorry about that, I'm more familiar with this regulation, but on SFDR, it has become the fact that fund managers use the articles as a matter of marketing themselves and saying, I'm Article 8 or 9, and this puts me in a better position, although some constraints that come from SFDR can actually limit the access to capital for some companies that could be very impactful. And so this is probably where I would see an issue, actually. If you have small companies that do not have the resources to produce all the data, all the KPIs that are required by SFDR, then they can be perhaps hindered in getting access to capital. And so this is, in this context, it would be counterproductive.
Adrian?
Adrian Schatzmann from the Asset Management Association here in Switzerland. I have a question for you, Xenia. You mentioned that the regulation is not such a big topic when it comes to mass marketing of private equity to retail investors. I wouldn't say it's a problem, but it's what stands between the offering and retail investors. As of now, as a distributor, I cannot offer private equity to any retail investor. And I would find it interesting to see on what ground you would open up. Would you open up just for private equity if it's impact driven, or would you open up for private markets in general? And that would be quite a fundamental change. And I would be interested to hear your thoughts on this.
Thank you. Yeah, so, I mean, you mean that if we would, for example, amend FIDLEG and the ordinances, or yeah. So one question we had when we were launching the working group was, do we need to have more flexible suitability checks for retail investors, and trying to build in some kind of like some kind of mechanism, making it more flexible just for impact driven solutions. But so far, so what I've heard from the financial market participant was that it's not really, that wouldn't change, that wouldn't be a game changer. So right now we didn't really pursue this avenue because, I mean, it's hard to make a case for amending legislation, especially FIDLEG, which isn't in place for so long. So we try to see what can the state do, what can the government do, except other than amending hard law. Yeah. So it's yes.
Maybe just from the asset managers, is there an appetite to approach retail investors today? Is this something that makes sense, or you don't see it happening? What's your view?
I can take that one if you want. I think it's a very interesting market. I think we did a study a few years ago looking at retail investors in Switzerland that have a liquid net worth between 50,000 and $1 million. So wealthy individual, but not the most wealthy individuals in Switzerland. And the number one criteria for the investment is impact. Because the problem is there is no real route to offer a product to them that is efficient. I think one of the problems is fees. You need to go to a distributor. And the other big issue is KYC issues, because we have a lot of KYC requirements for investments, for investors, typically hundreds of documents. And so if you're doing this with 50 institutional investors, it's typically easy. If you have to do it with thousands of individual retail investors, it becomes very challenging. And with the regulation in place, the KYC checks are still bared by the asset manager, and that makes it very difficult. But I think there is a real market, and we need to crack that code. I think even regular private equity hasn't really cracked it today, but there is definitely a market there.
Yeah. Okay, sorry. Yeah.
Thank you, everyone. I have one question following on this regulation. Well, the past 10 years there have been many advances in the financial system regarding regulation, and it's not only regulations of a policy, but when I see the capacity... thank you. When I see the capacity to advance in terms of impact investment, not only in Europe, I am from Latin America, so I've seen that part as well. I think that we got to a point in which we need to start addressing sector policy and regulation, because impact investment doesn't happen in a vacuum. If you're investing with an impact lens in the food industry or in agriculture or in oceans or in conservation, you're dealing with different markets. And when we're talking about an opportunity from an investment perspective, you're talking about a business opportunity. So I'm wondering to what extent you see a hurdle because of the lack or the slow changes in sector regulation or policies, which create incentives or disincentives or subsidies or you name it. Thank you.
Sector, but I can try and have a stab at this. So sector policies. So again, if I repeat kind of which sectors do we or which themes do we focus on? One of them is financial inclusion, and obviously that is a sector that is in itself affected by regulation. So what we've seen all along that kind of the way local regulators in country look at financial inclusion matters a lot. So in terms of the capital requirements put behind it, the licensing requirements, and then more recently, over the last 10 years or so, kind of what is the approach towards more fintech type business models? Is there an openness to open the payment system to new and innovative models? And in that sense, yes, that is affecting obviously the investment universe in which we're operating. Would I say this is today a limiting factor for growing impact investing in emerging markets overall? I would say no. I think there's ample opportunity across. There's certain sectors that are more prone, I would say, to government intervention and restrictive policy and regulation. Maybe education is one of them, or maybe the health sector is one of them. But when I look at the sectors that we're focusing on, there's ample opportunity. Opportunity is not the limitation here. I think formulating the opportunity in a positive sense. This is not an investment out of social conscience. It may be, but actually there is a business opportunity here. There's a concrete business case. And then finding the right structures to bring that to the investors here in the room, here in our markets. I think that's the key. Now, we have various structures that we work with. Institutional investors are very important to us of all kinds. We do have, and this more or less since the beginning, since almost 20 years, we do have a product here in Switzerland which is distributable to retail investors. It's not private equity, it's private debt. But this product exists, it's on the market, it's there. Now, would this type of product be approvable today? That's a question to the regulator, it's not our question. So I think there is a question here, how can this area of more broadly private assets, but then also impact-oriented private assets, maybe not private equity first, maybe it's more on the private debt side first, how can this be open to a broader investor audience? Because again, kind of the younger generation, and I'm not counting myself into that, but people are looking for these investment opportunities, and if this is about 1,000 francs, it's not about 50,000 or so, then what is the reason to keep them away from this? And how can this be addressed? Yeah, so how can we move from a risk-based view on this to an opportunity-based view, limiting, maybe talking about micro-investments as a way to manage the risk that is obviously there. There is significant risk, and that should be transparently shown.
May I just ask a question? So because we also think about how we can involve investors with a smaller portfolio into this, and how would building like vehicles of like pooling assets, so is that an option for you, and or also you picked there, or, you know, it's like building this I don't know, feeder vehicles that could give access to smaller tickets of capital?
Well, I think, as you said, Michael, I mean, these products, if you look at private debt today, you can distribute a private debt product to retail investors. The problem is not the product, it's the distribution channel today. You know, because the distribution people are not pushing hard enough this product to the retail investors because it's complicated to sell, right? The performance is not as good as maybe others, the volatility. So I think it's not a question of, for the private debt, it's not a question of product. It's a question of distribution power into the end of the retail investments. And why are, the big distributors of this country or other countries are not pushing this product? Private equity is another problem. It's a bit more complicated because it's not, but I think it's a problem really we need to ask ourselves about the distribution.
I think there are a number of solutions that are on the way, and that will, be seen very soon with the LTIF 2.0 structures or other structures that will enable more retail investors to access some of these components of the asset class. But it will have be done or it will be adapted to the retail world. So it comes with some constraints as well. First of all, private equity historically was meant for institutional investors for specific reasons. It's a long-term illiquid asset class. It's not meant for everyone to have a 10-year or 15-year-old investment in its portfolio. So it's something that has some characteristics of risk that have to be understood, and that maybe are not a perfect fit for retail investors. Now, there are a number of platforms as well that offer very accessible exposure to private equity that comes perhaps, again, with some other constraints, but I think it's going in the right direction. There is a broader understanding of it, and I think it's independent of whether or not these products will be impact-driven or not. There is a demand for being exposed to the real economy, being exposed to private equity per se, be it impactful or not.
I'll have mine of the One Goal initiative for governance. The question is for everybody. What would happen if there was a major financial crisis coming up? Would that negate some of the investment assumptions? And what would the impact of that on the impact that was intended be? Thank you.
I can answer for our portfolio. I think we've been through major crises in the last 3 years that have massive impacts on public markets, private equity holdings, And our initial view is that actually impact investing is defensive. If you invest in basic healthcare services, basic financial services, food and agriculture, climate transition, typically those are necessary services that won't stop because there is a major crisis in New York or in London. Similarly, we see on the climate side, if you're offering a product for climate transition at similar cost to incumbent products, I don't see the rationale why someone will switch back because of the financial crisis. At least that's the investment we target. And so we hope, and that's what we start to see. We've seen with the war in Ukraine, we see with raising interest rate, our portfolio was actually very resilient.
I would argue and say that, of course, if there is a major financial crisis, everyone will have an impact across the board. So, of course, there is no reason that financial assets, whatever they are, will be safe harbors depending on what they are. But and I think I get the sense of your question is to mean whether or not investors will turn away from being willing to invest in impact-related product versus others. And so I think I would agree with Nicola here that if these investments are made with a purpose and with a sensible purpose, meaning if the companies contribute not only to an environmental, for example, thesis, but also have an economic sense in what they do because they bring higher productivity for agriculture, or they make just more sense because they attribute energy more efficiently, or they treat water in their businesses. These businesses have economic sense, first of all, so they would be exposed to a crisis like any others, but I don't think investors would shy away from them because they have this positive contribution on top of economic sense.
Before we take more questions, I want to get into one last topic. It's the impact, right? How do we measure the impact? Because we've been talking about impact investing, and one thing we hear from the investors very often is that, this is an area where it's difficult to compare yourself. You talk about it a bit at the beginning, and how is transparent how you measure the impact on your investment, on the communities, on the people, on the planet. Without going into detail of how you measure your impact in your respective firm, how much progress do you think we've made in measuring the impact of your investment? And is this transparent enough? And do you think your investors are comfortable enough with the methodology? And are we able now to compare yourself among you?
Yeah, if I may, I think there has been progress because I've been there for 12 years and I started being the person responsible for impact reporting in our firm. So at the beginning there were many initiatives. IRIS was already there. There was a social evaluator. There was I don't remember, Pulse or something. And then there were all kinds of voluntary initiatives. And lately I think they were always with acronyms that were terrible and only for practitioners that like people in this room, and not for the greater public. But lately there was this impact management project that already gave a framework that was really useful. I mean, the SDGs, as you said, right? Investors, industries, they understand the SDGs, and we are here building bridge towards our friends who invented the SDGs, right? So I think it's going in the right direction. And with this SFDR you mentioned, and here I want to, it's not because you're a small company that you cannot fill the indicators of SFDR. We have 25 companies reporting in our impact report this year. We just published last week, and we are one of the only funds that is publishing a PAI, that's the indicators of SFDR on principal adverse effect. So I think it's getting there. And what I wanted to mention also that responsibility is doing and that we are doing is for the investor to compare investment. On a report by responsibility, correct me if I'm wrong, it's written that if you invest 100,000 in their vehicles for a duration of 3 years, you get that outcome, right, Michael? And we do the same in our impact report. Well, it's more, it's 1 million. If you invest 1 million, then the impact for 1 million is this number of smallholder, this number of jobs, this number of hectares or CO2 sequestrated. So this is, and we always try to be clear and simple, clearer, because the feedback we had from investors was too complex. Only a few nerds will understand our impact reports, and they are not the ones who could invest in our fund, right? So we tried this year to be more simple. I invite you to check it out. Our impact report is on our website. And then, yeah, it's going in the right direction.
Yeah, I can only echo this. You know, we've made huge progress, I think, moving away from the acronym soup to a more simple approach that is easier to communicate, at the same time more transparent and clearer. So we use the SDG framework. We set a few indicators. This is not kind of a whole forest of indicators, 100 indicators. No, we try to keep this very limited. It's three to five. It's 3 SDGs that are the primary reference point for a certain strategy. We report consistently against these. Yes, then you can calculate kind of how much impact do you generate or have you generated. There is the same footnote that you mentioned to these claims. Obviously, this is kind of looking back at the past. This is what a certain amount invested has generated. All of that helps a lot in the conversations. This simplicity is important, and walking investors through what is the thesis here, what is the impact thesis that is behind the strategy, and then for a specific investment, what is the contribution that this company will deliver and aspires to deliver against this SDG or that SDG. So I think that has developed a lot. And I think it helps, and it will help, and I see that reflected in the investor conversations we have, which are a lot more informed than maybe what they used to be. There is, and this we touched on the SFDR. I think there's a lot of benefit in the SFDR regulations and in the structure that it has brought. It is fairly comprehensive, and that's a plus and a minus. So yes, there is a cost to doing this. And the question is, who bears this cost? Is it the investee? Is it the manager? Is it the investor? Who ends up bearing that? Then there's also, in the principal adverse indicators, there is a certain lens that is being applied here, which may not always be adequate for emerging markets. So the type of reporting you need to put in place may be questionable. There is a bit the question, is it fair to ask, and this is the just transition question, is it fair basically to ask exactly the same question in terms of carbon emission efficiency to a small business in Laos than it is to a large corporate in Europe? Is that a fair question if you're in a territory where you are actually, in terms of emissions, ongoing emissions, not to speak of historically even, ongoing emissions, you're far below the net zero target? So I think there are some questions there in the detail, but more broadly, this is great progress.
There was a question, yeah?
Yeah, so thank you. This was part of my question. So I have just a follow-up on this. So in building bridges, there's a lot of talking also about nature and biodiversity, and I find some equivalency in the fact that it's very hard to put an index on biodiversity, not like in climate or carbon, but to what you are doing here in impact, because it's also very diverse and it's very location-based, as you mentioned right now with the just transition. So in biodiversity, I know that they are working in trying to unify it and trying to work together in a coalition to try to find these measurements. But here what I'm seeing is that you're talking about individuals. Everyone is afraid of talking how they're measuring it. Why not coming together and build this ecosystem as a coalition together to build this as something that is, I mean, when you say impact-driven, it sounds like data-driven, and in data we know what we measure, it's exact, this is what we're doing. In impact, I don't know what you're talking about.
I think there are a couple of frameworks that are, rising to the top today. I think, you mentioned IMP, which I think is a very usable framework for any impact investor. In terms of metrics, I think as a Gen with IRIS Plus, I've put together a very comprehensive database of standard metrics that we aim to use in every situation. So I think the frameworks are there and they're starting to emerge. It's just applying them consistently, setting them up at entry with your counterparty. They need to be part of legally binding documents, similarly to any financial disclosure you're asking. And if you do that properly, you will be able to collect good data. You'll be able to aggregate it. And similarly, you can look at our impact report that is publicly available. I think we've aimed to do that and to get better and better. But as long as you follow basic principle that you use for your financial disclosures, I don't see a big barrier here. Clearly, you won't be able to aggregate every number. If you're doing an education investment in South Africa versus a climate investment in Canada, well, they will fit in different buckets. But with that in mind, you should still be able to be able to compare, to track data. You just need to be consistent, use what is available, and it needs to be legally binding.
Question on the back over there. Yeah.
Hi. This question is mostly for the asset managers. What, in your opinion, is the fair cost of impact reporting? And how much returns are lost in terms of the impact reporting costs? Since as private equity, you need to do everything normal private equity does, plus do impact reporting. And considering a lot of impact analysts are based here in Switzerland and in places where salaries are not exactly low, how do you, as an investor, they want to know how much is spent on the impact reporting and whether any impact is lost because it's spent on reporting about it, or just what your views are and what is being done. Thank you.
I think I can answer this very easily, and it depends. So it's really a function of the underlying fund size to which the reporting would be attributed. But from what we see today, it's negligible. Really, it's if you have a few analysts and external data providers looking at exploring data, I think it's in comparison to a larger vehicle of several hundred millions. It's negligible cost, really, and I think it has the additional. It's worth this small incremental cost, but I think there are other costs related to different aspects of running a fund. Compliance is one, and there are several others that are much more meaningful than just the reporting cost.
But Michael, the cost is probably more important in developing countries, right? Where the data is not always easily available. What's your take on that side of the investment?
Yes, it's fund size, it's the investment size, it's the size of the companies, and the maturity of the companies you're investing into that will have an impact on the costs and how much of that cost ends up being kind of at investee level where you don't really see it. But it's there. So I think one of the challenges here is, despite the simplicity in terms of frameworks that we're trying to get to, in the end, what's the quality of that data? Most of this data is self-reported from investees, and there is a tendency to say, okay, some of this should be audited and regularly checked. Now, once you introduce that, it becomes a significant cost. If you want to check every year across a portfolio of 100 investments, do my impact numbers, are they real? Then it starts to become very significant. Now, that's not what's being generally asked, and I think it's right. So, my take would very much be there needs to be a systematic capturing of these indicators. There needs to be an active management of that, by the way, as well. It's not just reporting. It needs to be really actively managed. As an engaged private equity investor, you should be in constant conversation with your investees on these metrics. But I think we shouldn't go overboard with this, because then it may really become an issue. And in the end, kind of investors don't really want to pay for this. Right? So it needs to stay somewhere else in the value chain, that cost.
Okay, last question very, very quickly, because we have 1 minute.
A quick one, Henry Peter, University of Geneva. Back to the role of the state. I am assuming that impact-driven private equity is pursuing the public good interest, and therefore the state has to play a role. So the question is, are you considering to grant tax incentives in order to foster this industry? Question to you, and if so, which one, and maybe to all of you, is that realistic?
Thank you. So right up until now, this is not an issue, and it would be very hard also to push through it politically, I would say. So I see the idea, conceptually, but I don't see how we could do it right now in the political environment. But remains to be seen. Thank you.
Well, thank you very much, everyone, for being here. Our panelists are still here if you have any question. Thank you.